Hey everybody, it's Shannon from alphatrends.net. Today's Friday, the 24th of February, and this week we saw some selling, pretty hard too. Biotechs lost 6%. That turned them negative for the year. Dow Jones also negative on the year. So things are changing here, and we know that last week we were looking at the potential of a bull flag. I had called it a potential first because we only know if it's a bull flag if it resolved to the upside. Instead, this one failed, and it failed hard. In our 4-day week, we saw this market pull back down below the year-to-date anchored volume-weighted average price, and within a very short order, it will be right on top of that 200-day moving average and the anchored VWAP from the October low. So, we lost a lot of ground here, and what we do, as always, is we look to these bigger time frames on the left, the daily time frame, and we identify key levels of interest. A level of interest is a place where we might look for support to form if there's enough demand in that level. So what we do is we let it drop down to that level, and then when it's there, let's just call it 401, we look to the shorter term time frame. And the one thing that has saved me more money than anything else in my career, I've mentioned this over and over for the last couple decades, is the direction of the 5-day moving average. If the 5-day moving average, that's this orange line, is declining, then I don't want to buy. I'd rather miss an opportunity than just blindly buy at the year-to-date anchored VWAP. That's what we have here. With the declining 5-day moving average, we saw a couple of, this gap up, and then it failed yesterday and then rallied again and trapped all those people. For a day trade, I'll make day trades in the direction against the 5-day moving average, but I'm not going to hold them. In fact, today, I guess it was actually the NASDAQ. For the NASDAQ, we're right on the 200-day moving average and that year-to-date anchored VWAP. That's the one last week I said I wouldn't be surprised to see a test of that in the near term. Well, here we are. Does that mean it's a buy? Not to me. This is, day one of the test with that 200-day moving average and the year-to-date anchored VWAP. This is what it looked like intraday today, very choppy in there. What I was looking at was the potential midday, actually right, where was I? Right in here, I was pointing out that if it could get above this anchored VWAP from the noon high, then maybe it would run up and hit the 2-day anchored VWAP, but we didn't see that happen. That's why it's only a level of interest. What we want to do is always be aware of the key levels where the battlefield might be, where the battle between the buyers and sellers might emerge, and then look to the shorter term time frame to say, is there actually evidence that that's occurring? Now, you might look at this and say, well, that looks like support to me, and maybe it does, but I would also point out it's below the prior band of support from the last couple days. So I see support acting as resistance, and most important, I see a declining 5-day moving average. So going into next week, I think that you look at this market and, it's probably too late to sell short most things, and it's too early to buy. So there's nothing wrong with sitting on your hands unless you're a day trader looking for, active in and out stuff. And you don't do that on a daily chart. You don't do that on a 15-minute time frame. The Russell 2000 is also at a key level. Here we see this is the anchored volume weighted average price that we've had on since COVID. That had been prior support, then kind of a mess last year. But here it is, again, a battleground, as it has been numerous times. This is also the year-to-date anchored VWAP and the VWAP from this December low. So below that, we have the anchored VWAP from October low. And same is true for the S&P 500. That anchored VWAP is down here. So if the 200-day moving average fails to hold and we see a flush out next week, this might be where it catches a bid and then we get a bounce from. But again, it's only a bounce right now until the market proves otherwise. We have to allow it to tell us what to do on the shorter term time frames, and that's where we manage risk. Semiconductors, they had a sharp bounce on Wednesday. They closed right on the year-to-date anchored volume weighted average price, and on Thursday, of course, we had this big gap up, and I say it all the time. If you chase gaps with a declining 5-day moving average, you typically get what you deserve, as it quickly faded. Now, there was an opportunity on the long side for a day trade, but again, with a declining 5-day moving average. I don't hold these things overnight, and I don't suggest other people do either. Again, my time frame, you always have to consider the source. My time frame is that of a swing trader. I'm looking to hold for a few days to a few weeks. That's what I do. That's who I am in this market. You've got to make the trade your own. That has served me well over the last, over the bear market, and continues to today. As I've had some good trades long in the XBI this year, but you can see that once we lost that year-to-date anchored volume weighted average price, it told us that the sellers were back in control for the beginning of the year. They sold into strength, and they remain in control. Now, maybe it touches the 200-day moving average and finds buyers. I'm not going to look to buy there. I want to see this 5-day moving average flatten out and see a pattern of lower highs and lower lows, higher highs and higher lows. I want to see the lower highs and lower lows reverse, that is. So we have a clear pattern below that declining 5-day moving average of lower highs and lower lows. When you look at some of the individual names, actually, let's look at gold, because as I always mention, I don't trade gold. I was looking at this because a lot of people ask me to look at it from time to time. It was right on the COVID anchored volume weighted average price. That's the orange line. It was right on the 38.2% retracement of this low to this high. That's this line right here that says 38.2 over there. It was on the anchored volume weighted average price from the low of last year. So it is at a potential level of support at 169.5. Well, when we look at the chart at 169.5, I don't see any reason to be a buyer with a declining 5-day moving average. It's a level of interest, not a place to automatically do business. If you're unfamiliar with these terms or anything I'm talking about, they're all in my new book, Maximum Trading Gains with the Anchored VWAP. It's available on Amazon, it's available on Barnes & Noble, and it's available on Google Books. If you look at General Motors, here's a stock that has some pretty interesting ones. This is, again, the Anchored VWAP from the COVID low. Look at how that has been resistance twice now in the last year. And then this purple anchored VWAP had been resistance. It looked like it broke above it, but then it ran directly into that. You can't make up the accuracy of this. And it pulled back down to where? Right to the year-to-date anchored volume weighted average price. Do we want to buy it? Not yet. I certainly don't want to short it here as it's run right into the year-to-date anchored volume weighted average price. What would I be looking for a potential buy in here? It's going to take 3, 4, 5 days maybe of, maybe it rallies up like this. People get excited just like they did in the semiconductors, similar to this action right here yesterday. So back to GM, maybe it does something like this, then comes down. I won't buy it with a declining 5-day moving average. It has another little shakeout, starts to tighten up its range, then makes a higher high above the flat to rising 5-day moving average. I would want to buy it there with a stop under here. That's one potential scenario. It's not a prediction. It's not a trade plan. It's how you need to look at stocks, is use an anticipatory lens rather than always looking at what has happened. Instead of looking and saying, wow, I missed NVIDIA, maybe I should buy that up here. Well, the stock just ran 70% off the lows in December. That's a huge move, and it's looking good, but it certainly needs to settle down. It's stuck below the anchored volume weighted average price from the earnings, and I wouldn't be surprised to see, maybe a little fake out, come down, test the year-to-date anchored volume weighted average price. The bottom line is we've still got a market, which, as I've been saying since the beginning of the year, I think that the theme for this year is if they didn't scare you out last year, they will likely wear you out as the market proves to be indecisive, because we have an indecisive Fed. We have indecisive economics all around and global problems. So, play a strong defense or just continue to give your money back. That's the choice, I think.